What if I told you buying a single family home might be one of the biggest mistakes you can make? Most Americans buy 2 to 3 homes in their lifetime, but what if your first home could help you afford your dream home faster or get you started on your real estate investing portfolio? Let me introduce you to the concept of house hacking. And if you're not familiar, by the end of this video, you understand why buying a single family home might not be the best first step and how turning your first home into an income producing property can change your financial future. But before we get started, my name is Obi, a local real estate agent in Boston, Massachusetts. And if you need help buying or selling real estate in this area, feel free to shoot me an email. Now let's dive in. Owning a single family home is a dream for most people, including myself. I get it. The white picket fence, the cozy living space, it's a beautiful goal. But on average, Americans buy 2 to 3 homes in their lifetime. They buy the first house, get some kids, grow out of it, buy the second one, and maybe even a third down the road. Now, while that path works for many, what if I told you there's a better way to make your first home work for you? A traditional family home can limit your ability to invest elsewhere. Even though you do get that equity over time, you're still stuck paying that big mortgage payment every single month, which necessarily isn't that much cheaper than renting. Now, it doesn't have to be that way, and this is where house hacking comes into play. House hacking, which you may have heard on TikTok or Instagram recently, is what some people are calling real estate's worst kept secret. And if you haven't heard of it before, that's okay. Let me define it for you real quick so we're on the same page. House hacking is basically where you buy a property, usually a multifamily, live in one unit and rent out the rest. This could be a duplex, triplex, or fourplex. The rent you collect helps pay your mortgage, utilities, and other expenses. It's essentially living for less or sometimes even living for free. For most people, rent or a mortgage is one of the biggest expenses you'd have to pay on a monthly basis. Imagine even saving $1,000 a month because your tenants are offsetting your mortgage payment. This could help you save for your dream home faster, put more money towards investment, or even pay off your current home way faster. Let me show you an example. So I found this multifamily in Quincy listed for just about $850,000. And using the Zillow estimated payment, we can see that your estimated monthly payment is just around $5,139. So I'm not entirely sure if this is PITI, which is principal, interest, taxes, and insurance, but we'll just go with this number to make it a lot simpler for you guys listening out there. And we could just take a look at this multifamily. It looks pretty decent. It looks like it's been renovated outside recently. It has that new vinyl sliding. You could tell the roof looks pretty good. And it's literally on the water. It's as close as you can get on the water. And that's probably why they're charging so much for this unit. You could tell the pictures inside, it's not terrible. It hasn't been updated in a while, but the flooring looks pretty good. Hardwood floors here, tile in the kitchen. Some simple renovations can make this, more livable, I would say. And now let's compare it to the single family home that I found in Quincy as well. And this one is listed for just about $830,000. And if you look at the Zillow estimated monthly payment, we see that it's $5,012. So this is a really nice home. Like, the staging looks pretty nice. It's been recently renovated. This is probably a dream home for most people. But I honestly wouldn't recommend you getting this as your first home. And the biggest reason why is that you'd be stuck paying this $5,012 every single month by yourself or with your spouse, considering that you're married. But if we look at the multifamily again, so the monthly mortgage payment is $5,139. If you scroll all the way down to the facts and features, literally one of the last lines, you can see that the total actual rent is $2,400. So I confirmed this on MLS, which, if you guys don't know, is just kind of like Zillow for real estate agents. And I was able to confirm that one of the units is renting for $2,400, and the other one didn't have any rental history because it was owner occupied, aka the owner was house hacking this unit before he decided to sell it. And like I said, the monthly mortgage payment is $5,139. So let's say you did charge $2,400. That's super conservative. Say you didn't make any improvements or didn't up the rent in any way. $2,400 minus $5,139. That means your monthly mortgage payment drops to just $2,739. Think about how crazy that is. That means if you're, let's say you could afford the $5,000 per month shown in this single family home, but you chose the house hack and now you're saving close to $2,300. That's a lot of money you can put towards improving the property, making renovations, or even investing in other homes or maybe even saving that money and putting that towards your dream home. There's so many flexibility with house hacking, and having your first home as an income producing asset can definitely help you build equity faster and eventually upgrade to a dream home. The biggest advantage to house hacking is a low barrier to entry. Considering you're going to be living in one of the units, you'll be able to qualify for an FHA loan, which requires as little as 3.5% down. Now, I always recommend putting more down if you're able to. This could help you avoid PMI or, paying a lot of interest over the life of the loan. But 3.5% still is a very low cost to get into a property like this, like a multifamily. And let's compare that to the investor. The average investor has to put 25% down to get any type of investor type of property, multifamily, duplex, triplex, fourplex, you name it. For example, let's say you wanted to buy a $600,000 home. With an FHA loan, you can qualify for as little as $21,000. Compare this to the average investor. They would have to put $150,000 down just to get the same property with a conventional loan. In addition, FHA loans also have lower credit requirements. The minimum credit score for an FHA loan is 580, while the minimum for a conventional loan is 620. They also tend to have lower interest rates. However, the downside is that you'd have to pay a PMI, which is private mortgage insurance, and this can vary state to state and depending on what type of property you get. Another thing to keep in mind is that with the FHA loan, you technically have to live in the property for at least a year, or you would be committing loan fraud. So just keep that in mind if you're not really flexible on locations. But the good thing is that after you lived in there for a year, you could sell, you can move on, you can do the whole process over and over again. And that's how you really start building your real estate investing portfolio. In addition, your loan officer can count the rent that you receive from the other units that you're not occupying as income, which can help you qualify for a more expensive home. Lenders typically allow 75% of rental income from non-occupied owner units to be added towards your income for loan qualification. That means, for example, if you buy a triplex and plan to live in one of the units and rent out two other units for $2,000 a month each, the lender will be able to count $3,500 towards your monthly income. So how do you get started? Here are some key steps. The first step is to get pre-approved. The financing for a multifamily home is very similar to financing a single family home. There are a couple differences, but I would really recommend reaching out to a loan officer so they could guide you through the process and let you know all the steps that you need to take. But this is the most important step. I can't stress this enough. It's hard to look at houses if you don't know what your budget is or how much house you can afford. So make sure you guys get pre-approved. The second step is to research the local markets. This can be a little bit difficult considering you're going to be living in the unit yourself. So it's important to keep that in mind, but you also want to make sure you find a place that has good rental demand and you can get good rental income from buying your property in this area. So I would definitely recommend big cities. It's a no-brainer. There are a lot of people living in these cities, so there's more opportunity and more rental demand because there's a lot of people and they need places to live. Other areas could be the greater area of these cities. For example, Boston, it could be the surrounding cities, which still has a good sizable population. You definitely don't want to buy a multifamily in a suburb or a place where there isn't a lot of people unless you're for sure certain that you can get good clients and you can always have clients with no vacancies. In addition to that, some areas could be college towns. There are a lot of students that need housing. Housing is a really important issue for students. So you could be able to get some tenants there. Emerging neighborhoods, these are neighborhoods that you see in the next 5 to 10 years. You think that there's going to be a boom. There's going to be a lot of business in the neighborhood. A lot of people are going to be moving into these communities. 3, speak to a real estate agent like myself. We can provide so much value on your home search, and it's very important that you work with an investor-friendly realtor. What do I mean by that? That's somebody that has worked with investors in the past and has done deals with multifamilies in the past. These real estate agents can help you run the numbers. They can help you make sure you stay on track, and they could show you properties that fit in your budget and cash flow. And lastly, if you speak to a good agent, they may have off-market opportunities. Off-market properties are basically properties that haven't hit Zillow yet. They don't have any competition. Nobody else has seen them. And this is a perfect opportunity for you. If it works out, you could put in an offer and basically have no competition. Run the numbers. Make sure the rental income is able to cover your mortgage and other expenses. If you pick a good realtor, they could find all the necessary information from vacancies and also how much each of the units is currently being rented for. Biggest thing to make sure is that the rental income is able to cover a significant portion of your PITI, which is basically principal, interest, taxes, and insurance. This is the basis, 4 elements of your mortgage payment, and it's important to consider to make sure that this deal could work in your favor. Start small, think big. You don't necessarily have to start with a fourplex. That could be intimidating for a lot of people. Even a duplex is a great start. The biggest thing is getting your foot in the door and building that equity over time and getting a head start on your financial future. I know what some of you guys are thinking, but Obi, I don't want to be a landlord. And I get it. This might not be for everybody because house hacking essentially does make you a landlord. Managing tenants can be challenging, especially when they are your neighbors. But proper screening and systems put in place can make all the difference. Hiring a real estate agent to find you tenants can be a good option. They do all the digging with background checks, income verification, and credit checks. That way you don't have to be directly face-to-face with your tenants, but you still get to make an informed decision with all the information that's provided to you. Another benefit of this is that your tenants won't know that you're the landlord unless you tell them. That way you don't have anybody knocking on your door when anything is broken in the apartment or the toilet's clogged. And I get it, this is real estate. Things break all the time, and you might need to handle or fix some of these issues as a landlord. But my advice is to lie to them. Don't tell them you're the landlord unless you want to. Tell them that the landlord's your uncle or the landlord's your dad. That way, you're not the first person they come to when anything's broken. And if you want to be completely hands-free, that's why property management companies exist, and you could hire some later down the line. You might wonder, what if I can't find tenants? That's why doing your research is key, making sure you buy a property in an area of high rental demand, and also saving up a backup emergency fund for vacancies. Instead of buying a home, why not buy a home that works for you? House hacking is one of the smartest ways to build wealth and set yourself up for the future. If you have any questions or advice, feel free to drop them in the comments below. And if you got any sort of value from the video, leave a like. It really helps out the channel. And don't forget to subscribe for more real estate investing tips. Bye for now.